Welcome back, investors, to Ticker Time News. I'm Adam, and Alibaba's growth was severely limited under a terrible regulatory crackdown from the Chinese government, while investor confidence steadily eroded in the e-commerce giant. This was all reflected in the stock sinking over 75% and hitting multi-year lows earlier this month. This week, however, that gloomy posture has brightened tremendously after the company boosted its share buyback program to $25 billion from $15 billion. Now, the confidence-inspiring move conveniently comes less than a week after China's top financial policy officials vowed to ease off large technology companies and establish measures that support the economy. That proclamation has sparked a sharp rally in Chinese ADRs, including Alibaba, which is up over 40% since Bloomberg first reported the news of this major policy shift. Alibaba's share buyback announcement is adding fuel to the fire, signaling to investors that the tide may finally be turning for this group of beaten down stocks. Now, don't let your portfolio get beaten down too. Beat this crazy market with us by clicking the first link in the description. Okay, of particular note, main Alibaba competitor JD.com, ticker symbol JD, is trading higher by over 55% in just the last week. Now, as encouraging as this recent breakout is, I can't help but remain a little bit skeptical of its staying power. I mean, there are some lingering concerns I have in regards to Alibaba and the Chinese government. Hear me out for a moment. Number one, Chinese regulatory agencies tightening their screws is not the only challenge facing Alibaba. Rising competition from JD.com and others is also chipping away at Alibaba's growth and market share, forcing the company to ramp up its spending to attract new users. This is illustrated by the company's unpredictable quarterly performance, which includes two sizable EPS misses in the past 4 quarters, and its slowest revenue growth since its 2014 IPO just last quarter. 2. Unfortunately, the slowdown isn't just confined to Alibaba's core e-commerce business. Its cloud revenue grew by an underwhelming 20% in Q3. I know, 20%. That seems crazy, right? And to highlight how steep this deceleration has been, cloud revenue climbed by 50% in the same quarter a year ago. A combination of weakening economic conditions in China from the pandemic, waning demand in overseas markets, and a crackdown from the Chinese regulators after a cybersecurity vulnerability was identified has weighed on the cloud segment. 3. Buying back stock is not a new endeavor for Alibaba. In fact, on December 28, 2020, the company increased its share repurchase authorization to $10 billion from $6 billion. Under this program, Alibaba repurchased about $7.7 billion worth of its own stock during the 9 months ended December 31st, 2021. Despite these efforts, the stock still fell by nearly 50% last year. Now, Alibaba's enhanced stock buyback program, it provides a much-needed shot in the arm from an investor confidence standpoint. Along with a more relaxed regulatory stance from China's government, investors are viewing this development as a green light to step back in on Alibaba and other Chinese ADRs. But I still believe that caution is warranted. Based on the political regulatory unpredictability in China, the impact of COVID-related lockdowns, intense competition in the e-commerce space, and potential geopolitical risk, they are all weighing on investors fully jumping back in. But hey, that's just one opinion. What's your opinion on Alibaba? Let me know in the comments below, as your comments help us all reach financial freedom. Smash that like button, share this video, and beat the market with us by clicking the first link in the description. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.